I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
Well, you're here because you have some sort of interest in investments and what's going on in the world and how to maybe you'll learn something about what to do with your portfolio. And we hope that's true, that you get something out of that. One of the marketing issues, but maybe it's more than one, is getting individual investors to focus on segments of their portfolio and segments of their objectives. So when you retire, you need income. Therefore, you should be an income investor. But what
Right?
about inflation? Because income investing doesn't usually keep up with inflation. You're young. You should be investing in small cap stocks because that's where real growth is. But what happens when small cap stocks don't do anything for 10 or 20 years? Why should you be there?
Right?
The real issue is, let's keep it simple. Your objective is to have enough money to do what you want at different stages of your life. Your life is going to rotate through stages. The economy is going to rotate through stages. Politics are going to rotate through stages. Your kids are going to rotate through stages. Perhaps you should let your portfolio rotate through stages also.
Really
You need
important, Don. Really important point. And it's one of the prime reasons that those portfolio differences get parsed out is marketing. They're trying to sell you something, and they can't change everything you're doing. But just take inflation. You mentioned inflation. Inflation has been in the news for the past couple of years. Back in 21, it took off, and all of a sudden in 2022 we got 9% inflation. Nobody could believe it. Well, you need inflation hedges. Everybody needs it. The inflation's off the charts. You have to hedge your portfolio. That means we can sell you a bunch of stuff. But what's the best hedge for inflation? Buy good equities and stay in front of it. Grow with it. Ride that wave. But that says, well, you're just doing the same thing, and we're not going to sell you anything new. So that doesn't sound cool. So we need to have you need an inflation hedged portfolio, and that gives us a whole new set of things we can sell you. It's important not to get driven off track by those, because they're going to tell you you need an income portfolio, and you need a security portfolio, and you need a hedged portfolio for inflation. And those are probably all the same portfolio. There's an old saying in investing that all portfolios are income portfolios. No one invests to grow a huge portfolio and just let it sit there. You invest to grow that portfolio, and then you use it for something. That's income. Everybody's portfolio is an income portfolio. So don't get bogged down with the definitions. And like you said, Don, follow the rotation, follow the money. Where are we making money? Do that. That's the best way to beat all those things together and not just get sold whatever the subject of the day is.
And one of the recent subjects of the day has been buy gold because gold is setting
Sure.
new highs. Well, it's
Yep.
about time, because the last time it had a pattern of setting new highs was June or July of 2011. So it's due to set
Think
some
about
new
that.
highs, but it has
Yeah.
not been an inflation hedge during that entire period of time. And that's a misnomer. When inflation's going up, people think gold is an inflation hedge, and so the salesmen buy more time on television, they buy more time on radio because people buy into the correlation. But
They do.
actually, it's a crisis hedge more than it is an inflation hedge. The inflation assumption comes out of the mistaken correlation or in the 70s, and it's assumed that inflation was the causation of gold rising, but actually it was that the government decided to let gold price rise based on market demand. So after having gold at a fixed $35 for decades, suddenly we could buy and sell gold for whatever the market would bear. That so the inflation
A
was
rather
not the
significant
causation.
change.
Yeah,
Yeah, a huge change. Yeah. So
it was
of
a
course it went
change
up.
in market, and it's become more related to crisis hedges to get money out of the country. When the currency has collapsed, it's not worth anything. If you're
Right.
fleeing Russia with rubles and you get across an international boundary, who wants your rubles? But
Right.
if you can carry gold or diamonds, you know you have some value on the other
Now
side of
you're
the line.
talking.
Yeah,
Correct.
so
Correct.
that has changed. And I had a conversation with a client this last week, and we were talking about what's rotating in the market. So, well, the U.S. market is actually struggling. We know that. We turn around and look and see that it's been stuck at new highs. It just can't get into the new highs that have been established over the last 3 or 4 months. Well, where's the money going? If it's not going there, it has gone to gold because gold is rising. That's where money's treated well, and it's being treated well in the gold market. It's also
Indeed.
being treated well in international markets. So international markets have recently been outperforming US equities. Well, how many people even pay attention to international markets?
Correct.
It's not high on the what do I do today with my portfolio, or what do I do this week or this quarter. It's on the back burner if it's even on the stove at all.
At all. That's well, they've done poorly against the U.S. market for so long. Internationally based firms have been underperforming U.S. firms for a long, long time now, and you people get out of touch. They stop watching, even when things aren't doing well. Even for the decade where gold was doing poorly, we check it all the time because you don't know when that rotation occurs. You don't know what's going to drive that rotation, why that switch happens, why the money begins to flow into or out of any market sector. You don't always know why it's going to happen, and you never know when it's going to happen. The only way you can track that is to stay on top of it and watch it. And that's why we continue to keep all of those sectors on our radar. We look at them all the time because you never know when something's going to take off, and you have to be paying attention all the time to be there when it does.
So it doesn't mean you have to pay attention every day, but at least
Correct.
on a systematic basis, you're looking at your portfolio decision matrix. How do you make decisions? What do you have in your universe of things to buy? And when they aren't working, will you sell them because they're doing you harm? You have to have rules. We operate off of rules. We don't have a forecast. We don't know where things are going to be over the next 2 or 3 or 5 years. And certainly no one that you're talking to knows where things are going to be if your retirement is 5, 10, or 30 years out in front of you. That is
Correct.
an unknown factor. The only thing you do know is what's going on today. Money moves. We had a recent podcast where we talked about the New York Stock Exchange moving to Texas. That's serious money movement.
Oh yeah,
We
top of the
we
top of the heap.
we
And
know that.
in your personal portfolio, Don, you just covered it, but I think it's important to highlight it again. You have to have rules to run your portfolio to prevent you from being emotionally involved as much as you can with what's going on. And the biggest set of rules are a sell discipline. It's easy to see, hey, this is going up. Let's get some of that. It's much more difficult to tell yourself it's time to move on. We have to sell that. And that's how that rotation in your portfolio occurs. You have to trim off those things that aren't working well. And that's the biggest part that's missing in most people's portfolios because they're buy and hold investors, they're pie chart investors, and you're supposed to buy it and then just walk away and leave it there forever. And your portfolio becomes this warehouse of stuff you've bought for the past decade and everything just stays. Then you end up with a little bit of everything and you're just getting market returns because you own virtually everything that's out there and nothing ever gets sold. And we never buy anything in any of our client portfolios that we don't already know when we buy it. Here's what needs to occur for us to sell it, and you need to keep that at the top of your list of things you do also. If it never hits those things, great, keep it. That's fine. But know when it's time to sell. And then when it's time, you need to do it. And that's the discipline part of running a portfolio.
Well, you remind me of a conversation with one of our financial advisor friends on the East Coast who was meeting with a prospective client at the time and going through their portfolio and asking, why do you own this? Why do you own this? Why do you own this? And the prospective client was saying, well, I don't know. My broker put it there. My
Right. There
broker
you
put
go.
it there. He said, well,
I don't know.
particularly at the time, the conversation ended up on Hewlett Packard. He said, well, why do you own Hewlett Packard? Because look at, you're losing money in it. He says, I really don't know. Could we call your broker? So they did. The two of them called the broker, and the advisor, our friends, asked the broker, why is Hewlett Packard in here when it continues to lose money? And the broker said, well, Hewlett Packard's a good American company and everybody should own some.
Yeah.
Well, should you own a whole bunch of companies that are sucking wind? That's a very long-term view, assuming that everything will work out in the end. Referring
Right.
back to a conversation you and I had on a former podcast about cell phones.
Sure.
There was at a time in history, there was a time when there were a ton of cell phone manufacturers. Today, not so much. Well,
Right.
what if those companies that you own that aren't doing you any good are part of those companies that are not going to survive? How long are you going to hold on to them? You need rules. What
Correct.
are your rules? And your cell discipline, as you just said, is one of the most critical rules that you have in a portfolio. And most portfolios under standard financial advisor training today is you never sell anything until it's dire. And the client complains, why are we owning this thing? And finally, the pain issue is high enough. Okay, Mr. Client, we'll go ahead and we'll sell that and we'll put this in instead. Do you like that one? Does that one sound better? And you say yes, and so you get a replacement. That's not a portfolio that's being driven by market data. That's a portfolio that's being driven by your limbic system. And
There you
the
go.
broker is basically sitting back in the recliner chair saying, oh, this is such a great business until the phone rings. And now I got to do something. We
Right.
actually believe that if you track money, you pay attention to where money goes and you review it systematically, you can avoid the major mistakes in your portfolio in the market.
It's true. And that doesn't mean every trade is a winner. That doesn't mean you never lose money, that your portfolio never goes down. It just means that the majority of the time, the odds are in your favor when you make a trade, whether you're buying or selling. It keeps the odds in your favor. So you're still going to have the clinkers. You're still going to have, well, I wish I'd never bought that. But the difference is you don't buy one that's not working and hang on to it. You buy one that's not working and it hits your cell discipline numbers and you get rid of it and you rotate that to something else and you try again. And as long as your process is refined enough that most of the time you're hitting a winner, you're ahead of the game. You're going to have the losers. Everybody does. The point is, what do you do with them when they're in your portfolio? And the answer is not just hang on to them forever. Have a point that you're going to sell them, and when you do, have a process that leads you back to the stronger parts of the market. That keeps the odds in your favor, and that's really the best you can do.
So we're right back to our subject, which is keep it simple. Managing money can be complicated if you make it that way. But for an average retail investor, you do not need to be a rocket scientist to manage a portfolio. You may not want to do it, in which case you hire somebody to do that. That's why people hire us. They don't want to do the work. They don't want to buy the software to take care of it. They don't want to regularly sit down and look at their portfolio and be forced to make a decision about what to do this week or this month or this quarter. But it's not that difficult if you establish rules, follow the rules, keep it simple, solves most of those problems. Indeed. You want to contact us and get a free analysis of your portfolio. The way to do that is popping up on the screen here momentarily. Stay with us, subscribe to our stuff, and we'll be back with another subject in a few days. And have a great day.